let me try to get a good sense of people in the audience. So how many of you are entrepreneurs? And okay, those of you who are entrepreneurs, how many are either fundraising or think you might fundraise in the next 6 months? Okay, quite a few. And then we have a bunch of investors in the group. Is that, okay, great. So because it's a small room, what would be really helpful for me is if there's anything you want me to talk about, just ask me, and I don't mind deviating from the slides that I have prepared. There are 2 areas that I have found people like hearing about. One of the areas has to do with fundraising, so I wanted to make sure there were enough people who are into that. So I'll just say a little bit about like what I have found works, and then the other area are just the highlights of I've been in the tech world. Oh wait, sorry. For about 20 years and started a few companies. I've invested in a bunch. There's some examples. I've been on a bunch of boards. So I'll just talk about the things that I've seen that have worked best for people, not just me, but the people that I've seen around. But let me start just real quick with fundraising to get that out of the way. So what I have found is people who are most successful at fundraising are the ones that target the right investors. So the analogy I like to give is, suppose you go out on a date and you're really worried about taking her or him to, do you do Chinese or do you do French? Do you dress this way or that way? Well, if there's no chemistry, it's not going to make a difference. On the flip side is, if there's chemistry, it's not going to make a difference. It's going to work. And most entrepreneurs don't seem to realize that. They'll go and work so hard on their pitch, and then they go to the top 20 on Angel List and start to going after them. What are the odds? It's sort of like going the yellow pages to try to find a date. So you have to really do an effort to find out who is likely to be a good fit. So, and I think if you get a receptive investor, you're half the way there. Other things that I have found that work is not just remembering that you're not selling your product, you're selling your company. So many investors, entrepreneurs come and are just pitching their product. And then the end of the pitch, the investor goes like, but wait a minute, what about the marketing? What about the unit economics? What about the traction? What about this? And those, if at all, often get just very, very little airtime. So remember that it's a company that you're selling. And then the final thing, which I think for the dating is similar, and particularly here in Silicon Valley, most of the active investors, we see many more great companies that we can invest in. I mean, take me. I usually do 4 or 5 new projects a year. I see 20 that I think are great. And the hardest thing I have is to decide which of those 20, out of the many more that I decide, no, these are not great, but of those 20, which are the ones that I really want to do? And it's not the ones that check all the boxes. It is the ones that get me excited. There's something about them that's special. And what ends up happening is that if there's something that's special, often some of the boxes are not checked, and you ignore it. It ends up being very emotional. And I think that is the same with most investors. It's about making that connection. So when you're trying to get an investor, it's more about getting them excited than about making sure you're covering your bases, if you will. By the way, please interrupt me, ask questions, pause me, that way I can. So when somebody doesn't get excited, it's kind of awkward to say, sorry, I'm just not excited about your company. It's just, what kind of answer is that? Or worse still, maybe they don't like you. Maybe they think you're arrogant. Maybe they think you're not smart. So they think, well, what's a good excuse that they can't argue with? You're too early, we're restructuring our fund, this or that. And that's never what's going on. But here's why that's important, because I often see entrepreneurs who get that kind of excuse, and then they go try to solve it. We're too early, we're gonna get later, and then go back to this person. He didn't like you before, he's not gonna like you later. So don't waste your time. The other thing to keep in mind is most investors wanna keep their options open. Why am I gonna tell you, you know what, this is not good fit, go away? Who knows, maybe you get lots of traction, and then I'm excited. So I try to be nice and say that I like it and so on. But unless you have a check in your hand, the answer is no. And remember, I've seen the biggest VCs write the smallest checks, and vice versa. It's just if an investor wants to get in, they get in. So keep that in mind. Now, sometimes you can find out what's going on. And to go back to my dating analogy, and I hope you don't get any ideas here, but let's suppose that you ask someone on a date and she says, you want to go out on Saturday, I'm really busy. Okay, and then you say, oh, what about Sunday? Oh, my mother's in town. And then the next day, what about that? Oh, I have to work. She's not going to tell you the real reason, but maybe her friend will. So if you know her friend, you go to her friend and say, I've been trying to get Sandra out. Do you have any idea? Yeah, she actually mentioned, she just thinks that, the way you dress is just too awkward or whatever. You might get some insight that you might be able to address or not. Maybe she'll say, she thinks you're an idiot, so then you move on. So do try to get those back channels. How are we doing? You're not asking questions. You're not saying anything. We're good. Oh yeah, you guys want to come in? There are 2 seats here.
There's some over here.
And there's a little bit of floor space. So the entrepreneurs that I see that are successful tend not to be too concerned about, am I raising my money from a VC, from an angel? It's more about who are the individuals that I'm partnering with. So I can't emphasize that enough. I mean, there's some amazing firms that have some people that I wouldn't want to work with, and some firms that are not particularly well known that have some awesome people in them. By the same token, there are some angels that are way more sophisticated than many VCs. So just focus on the individuals. Are they a good fit? Don't worry too much about the other things. Sometimes people worry about, if it's really early stage and I get a VC and then they don't invest later, is that a signaling problem? That was my last bullet there. And the short of it, if things go great, you're not going to have problem raising money. If things go bad, you're going to have problem raising money. So at the end of the day, it's how you do, and those signaling problems or risks are way exaggerated. Any of you from outside the valley came here from outside Silicon Valley? Okay. Oh yeah, there are a few. Great. And by the way, Fiji. Well, so it's interesting. Whether you're from Fiji or whether you are from Sacramento, I think most investors here, it's foreign. If you cannot drive within an hour, it's abroad. No, I'm not kidding you. But here's what happens. Here's how I think most active investors here feel. Imagine you're a young kid, or your mom takes you to the candy store. You go to the store has 500 variations, and you see like 20 that you really like, and she says, pick 3. 3, I like 20. So when you're trying to decide which 3 of the 20, your friend comes and say, 3 blocks from here, there's another candy store. Why don't you go there? Like, are you kidding me? I mean, I have so many here. Why am I going to risk getting run over by a car going to another candy store? Now, if that friend says, well, that one candy you really, really love, they don't have it here, they have it there, maybe you go. So it's not an impossibility, but the bar is so much higher. That's the bad news. The good news is Silicon Valley, in my experience, is the only place that has that situation. Go anywhere else. Go to Boston, to Seattle, to London, to New York, to Miami, and no other investment group can afford to do that. They all are used to investing outside. So just something to think about, that sometimes if you're from abroad, whatever that means, and you're having a hard time here because of that issue, you might do a lot better, at least initially getting going with other places. Now, to clarify, abroad means that you are there, not that you are from there, because we are all from somewhere else here. I'm originally from Venezuela, so where you're from is irrelevant here in Silicon Valley. What matters is where are you. But if you are based somewhere else and you're in town every month, then most investors here go like, okay, why do I want to put up with that when I have so many choices of people who are already here? That's another. I'll just touch on this really quickly. Some people, and again, I have to agree to disagree with other people. Some people get really carried away. Is it price? Is it a convertible? Is it a safe? I couldn't care less. I want to make sure that that it's simple and that the basic terms are fair. So if I'm doing a convertible, the cap needs to be reasonable. If I'm doing a price, evaluation needs to be reasonable. But other than that, I think most investors are not too particular about that, particularly at the seed stage, and I don't think entrepreneurs should care about that either. You want to be in a good project, and usually it matters when things go south. Most investors are not investing for when things go bad. We're investing where things go well. Yeah.
What's a reasonable cap on the value right now? Is it reasonable?
So the range is pretty broad, and there are a number of factors. Depends, for example, on depends on where the company is, stage-wise. Depends on how much you're raising. So here's a really interesting thing. If you're raising $500,000 on a seed, and let's say you're doing a $4 million valuation, so many seeds are priced. You see somewhere between like 3 and 8. I don't know. That's kind of a range. And if you're raising $500,000, you're at a $4 million, so you're giving away a little more than 10% of the company. It all sort of works out for the investor, for the entrepreneur. But imagine that same company is raising $1.5 million. Now, nothing has changed, but you're raising 1.5. All of a sudden, at that valuation, you're giving away a third of the company. That's problematic. So sometimes you're able, just because you need more money, you're able to just justify a higher valuation because otherwise you're giving away too much. The flip side is sometimes I see entrepreneurs that said, oh, I'm going to do a, say, $7 million valuation. Might not be too unreasonable for where they are. But by the way, I only want to raise $300,000. So I say, wait a minute, you're going to use, and that's what I need to get to the next level. So your early investors are going to get less than 5% of your company. It's like, to me, that feels unfair. To me, that feels like, I don't want you to give half your company, but 5%, that doesn't seem right either. So I tend to personally look at the percentage of the company that's being given away. It depends on how competitive it is. So for example, you might know there's some, in particular, Y Combinator companies tend to command a premium. So you often see them at 8 or 10 or 12 million valuation, while a similar company that's not a YC might be doing it at 5. But even some of them go lower. I often see experienced entrepreneurs, I not too long ago did a serial entrepreneur, and we valued, he raised $1 million at 4. He could have gotten 10. But I think he knows that it's long term, that he wants to get everyone excited, so sometimes the experienced entrepreneurs realize it's more about getting the right investor and not about minimizing dilution, too much. You don't want to go crazy. Right? So, all right, so that's as far as fundraising. Before I move on to beyond that, any other fundraising questions, comments? I know there's some investors here that actually know as much or more than I do, so you guys are welcome to chime in if there's anything that you guys think I missed that is really important. Yeah?
Yeah, can you just give a couple of examples of why the importance of this personal chemistry connection? I mean, isn't it you get the money, you do a good job, you make your numbers, good things happen?
It depends on the investor. So take me. I don't have a fund, and this might sound so. I am not investing. I don't want to lose money, but I'm not doing this to try to make a lot of money either. I'm doing this because that's what I enjoy doing. I want to have an impact. I want to keep enjoying it. I want to help entrepreneurs. So for me, life. And here's the other thing: you never know. Things might look great, but many of the deals are going to go south. If something goes south with someone you enjoy working with, at least you enjoy working with them. No, I'm serious. It's similar to some entrepreneurs who I hear their main motivation is, oh, this is going to be huge and I'm going to make a ton of money. It's like, oh, that's so risky. Because if things all of a sudden don't look so good, you're going to be miserable. If on the other hand, the entrepreneur says, I love this space, I want to make a difference, it's like, well, one way or another, they probably. So for me, I feel like life's too short. I only want to hang out with people that I enjoy working with. But you are right. I have passed on some amazing deals. And I knew it at the time. I didn't know how amazing they would have been. I probably would have just said, okay, no, I'm going to do it no matter what, because of that. So it is a trade-off. Now, and I imagine that for some people who have, maybe they have a fund and then it gets more about, okay, I want to make sure that the numbers work. The other factor is how engaged is the investor. There are some investors who are less active, so for them it's less of an issue if the entrepreneurs are not particularly nice. I tend to only want to do projects where I'm going to be very active. So that's, but it's interesting. people sometimes compare your investor selection to a marriage, but it's even tighter. I mean, if you marry the wrong person, you can divorce normally, at least in California. But if you get the wrong investor, very often you're stuck. I mean, there's no, I'm gonna give you your money back. So yeah, it's something that you really want to be super careful about.
And from the investor and from the entrepreneur's point of view, obviously it's great to have options. And so if you don't have options, you might have to take money from someone who might not be your first choice. But if you do have choices, you really want to think long and hard about who you want to be on your board. Because especially early investors, they might have a board seat. They're certainly going to have some influence, and you will be working with them, and their values are going to flow down to you. And you just got a new boss. So you take money, you just got a new boss.
Right, and you have to, I think at the end of the day, you have to value that, because let's say you're comparing a better valuation with someone you don't have the chemistry with against a lesser valuation with someone that you do. You know, how much is that chemistry worth?
Well, I'll give you an example. I won't tell you all the details, but I'll say that one of the companies that I'm on the board of, we just did, I'll tell you, Strava. We just did a round of financing where we got Mike Moritz from Sequoia. I've known Mike for many years, really like him. The CEO went and met him, and he's like, I really like Mike, I want Mike. I mean, we had an offer from another firm, a top-tier firm, that was like significantly higher valuation. I mean, we're talking like we were gonna get same dilution, millions of dollars more. And we said, it's not about that. We think the value out of having the right person, it's worth it. And I've seen that play out many, many times. And it makes sense because the people who might be a bit of a disadvantage, maybe they're not as well known, or maybe they're not as good, they have to pay up sometimes. But the guys who are not, they don't. So, and I will always take the better investor over the better valuation. You're reminding me of something else, which is, here's something else that you want to be careful about. I sometimes see entrepreneurs who, when they're doing the first seed round, and they're trying to get the best possible investors, but in doing so, they're spending months and all this time, and they're not running their business. And while they could have gotten the money from okay sources and move on. And particularly for seed, I mean, let's keep this in mind. The investors, even the best investors, we help at the margin. We only help so much. At the end of the day, it's about the business, the entrepreneurs, and so on. So I often encourage entrepreneurs, if they can just get some money, get to the next level, maybe if things go well, worry about getting that awesome investor at the next level. Don't get too caught up on, I have to have the absolute best investor, because, and you see it all the time. You see when companies get some okay, but not top investors, they do great, and next thing you know, there's Benchmark or Sequoia or whoever, or Andreessen Horowitz, interested. All right, I'll keep going. This is usually the first slide that I use, so I apologize. I moved the slides around, but it's very important, which is you're gonna get, you get advice, and it often contradicts the advice one person from the other, and you obviously can't follow everything. Sometimes you get bad advice, but more often it's not that it's bad. It's just that there are usually more than one way of doing things, and it's also often very personal. Entrepreneurs sometimes will say, "Oh, should I raise more money, less money, do this, do that?" It's like depends on what you want to do. It's very personal, and so on. So it's important to understand where the advice is coming from, and then take what works, throw away what doesn't work. I love to sail, and there was a time when I was racing, and I was not going as fast as I wanted to, and this pro sailor came on board, and he's like, "Okay, you need to pull the tiller more to the left, the sail out, the weight forward." I did what he said, man, I'm going faster. And then literally 2 weeks later, another guy comes, and he's like, weight back, sail in, tiller to the other direction, and I'm going faster. And I'm like, how can this be? It's because any one of those things on its own doesn't do any, it's not the answer, but there are many combinations that work. But if you say, oh no, he said tiller up, and no matter what else is going on, I have my tiller up, then, and I've seen entrepreneurs do that, obviously that's not gonna work out. I mean, the most successful entrepreneurs that I've seen understand that it's not a sprint. And I have not seen in the 20 years or so that I've been here in Silicon Valley, a single instance in which a company, because they executed so fast, then that's what made them huge. Sometimes you get a first mover advantage, but in most of those cases, it's not because you executed fast, it's because your timing was right. But more often, what happens is you just have to do the right thing. It's like, what good is going fast in the wrong direction? And when I was doing my first startup was the first web analytics company. So back in '95, we're thinking, we have 6 months to nail this market, and if we don't nail it, it's going to be game over, blah, blah, blah. And I mean, there were companies that were started years later in web analytics that went public. And there I was thinking that if I didn't nail it in 6 months, I was going to. So just focus on feeling good about what you're doing. Now, that doesn't mean you're going to move slow on purpose or that you're not going to very fast figure out the right direction. So what you need to be fast about is refining your course, not trying to get lots of customers if maybe the customers you're getting are not profitable or not in the right space, because then it becomes really hard to change course. And I've had this problem. You get all this install base, all these customers, all this stuff, and you realize, oops, this is not really what we want to be doing. There's an adjacent space we should have gone, but now you have all this baggage. So you need to. Oops. How are we doing? This one I stole from my friend Ali Partovi, who some of you might know, great entrepreneur and investor. Somebody asked him, how do you replicate Silicon Valley? And in somewhere else, he was giving, at least when I heard him say this, he was giving this talk in Vegas. And he said that the key thing that we understand here is how to deal with risk. And that the way we do it is that we take risks, and risks are fine. And the way we hedge our bets, the way we control that risk is over time. So in one time, if you're an entrepreneur and you're building a feature, you do one, you try to do it really well. If it doesn't work, then you try a different one. And if it doesn't work, you try another one. Or if you're taking a job in a company, you take one job, you go all out, and if it doesn't work, you're going to have time to get other jobs and so on. What we don't do is to say, well, let me split my time between my startup, my consulting job, my half-time job, and my school. Because then you don't do anything well. Or let me not go into this market, but try 5 markets at the same time. Now, you can experiment until you have decide where you want to focus. But in general, what I see here in the Valley is we make bold moves, one direction, very focused. I mean, this is probably the most common feedback I hear investors give to entrepreneurs is focus, focus, focus. You're not focused enough. I mean, if you ask me, give an advice to someone, you don't know who they are, but it's likely to be correct. I probably say that. But that doesn't mean that you focus on the same thing indefinitely. That's the key. Once, if you realize it's not working, you got to move on. This one is, so I've been fortunate enough to be involved with a bunch of high-profile companies about which books have been written, where it was Twitter. I was on the board of Odeo and was involved with incubation of Twitter. Was on the board of Link Exchange, and then was where Tony Hsieh was there. Then he went on to start Zappos, where I was an investor. I know that I was involved with Yahoo in the early days. And then I go and I read these books, and it's total revisionist history. Instead of saying, well, we were trying this little thing, and all of a sudden this other thing happened, and it caught us by surprise. We ignored it until we had so many customers we couldn't ignore it anymore. So they said, oh, we had this big vision, and da-da-da. And here's why it's important to know that that's not the way it really happened in, I would say, almost all cases. Is because if you try to emulate that, you're not going to succeed. If you say, oh, okay, I have to have this big vision and the multi-billion-dollar project, and until I have that, if I'm not going for that, I'm wasting my time because I have to do it the same way the Google guys did it. The way most of those guys did it is they had a small idea and they started executing and things went well and they got to first base, to use a baseball analogy, and then they kept playing well in second base and third base. And once you have the ball, the bases loaded and you've got a momentum and people have paid attention, you attracted a good batter, then you can maybe go for the Grand Slam. If you go for the Grand Slam on day one, in no likelihood you're going to strike out. So just don't try to emulate what you see in the books, the blogs. It's incredible. I get scared about when I read about the things that I don't know about, because like everything I read when I know it's not true. So how do you trust any of these things? So yeah, just really take them with a grain of salt. Particularly this component of how there was a strategic vision on day one. Most of the biggest successes in the Valley didn't have that. They just evolved over time to something that took off. And in many of those cases, they were successful in spite of themselves. Plenty of examples where it was just, they hit a nerve, and again, timing was right, something else was right, and it worked out. Usually when things start going well, then it becomes easier to execute better, to attract better people, to attract better backers, so you see the execution improve. And sure, there's some cases when there's like something brilliant at the beginning, but those are rare exceptions. So I was at actually at our 10-year reunion. We had a panel with some great people. I think Mike Volpe was on the panel, who was again, some great successful people were in the panel. And I think there were 4 of us, and somebody asked, okay, if you had to sum up the last 10 years into like one piece of advice, what would it be? And I think that 3 out of the 4 said this, hire slow. And it was amazing. But so often, and by the way, this applies not just to employees, but it applies to partners, to any situation where you're making a commitment of working with somebody. If it doesn't work and you have to break it up, it's often very painful. Because of that, in most cases, people postpone it. And the more you postpone it, the more painful it is, the worse it gets. Here's my rule of thumb, and I know this sounds extreme, but honestly, the moment you think somebody might not be working, it's done. Move on. If the thought is even crossing your head. Now, I'm not talking about large corporations. I'm talking about startups, less than 100 people, maybe even smaller than that. And why do I say that? Because maybe in 1 of 100 you could fix it. But that's 1 of 100. I mean, the odds, in my experience, are 99 out of 100 times. If you start thinking that way, you end up concluding after months or sometimes years of painful and waste of time and so on. Now, what that means is, because you don't want to do that, right, is take your time hiring, take your time. The pressure is so high, and this goes back to the speed thing. I've seen some entrepreneurs like, I'm just desperate for this product manager, for this engineer, for the whatever. So this person, just bring them on board. It's just I would say unless you're pretty confident the person's going to work, don't do it, because even when you're confident, it often doesn't work. But if you have doubts on day one, it's so much better. Move more slowly, take your time. The risk is just too big because when it doesn't work, it's really bad. And I think the related points are, I'm just amazed about what relatively poor job most people do at vetting candidates. I mean, people call me for references, and they do such a superficial job. I'm terrible candidates. I'm ready to try to give them a heads up, and they're like, "You love the guy, right?" I'm like, "Well, okay, thank you." I'm like, "Okay, all right." It's not like I hate this person. So really, be thorough with references. Try to get the person in for trial if you can.
What are some good questions to ask that will unearth, any red flags or yellow flags without necessarily being,
Sure, no, that's a great question. So let me say 2 things. The first one is, ideally you can get some back channel references. So not the person's friend, and in the Valley that is actually usually not that hard. So can you get someone that trusts, wants to help you more than they want to help the candidate? Now, even with the reference from the candidate, I'll give you an example of one that I sometimes use. So sometimes somebody's being difficult in terms of they're not saying anything negative. I'll say, well, if I tell you that someone, this is a hypothetical, somebody said that there might be something where this person might be able to improve, what would you guess this person would have told me? And so then you put them in this double hypothetical, maybe they could have told you, and they toss something at you, and then you take it from there. So that would be one thing. The other thing is just ask for specific. Very frequently somebody says, oh, this guy works so hard. Okay, can you give me an example of a situation where he worked really hard? Well, on Friday he stayed at 6 until 5. Okay, well, that doesn't say much. As opposed to, we had this release and he was there for 3 months, day in and day out. So asking for it's so much easier to give a high level praise, but then when you push them down to, so this person is creative. What did he do? What was the creative thing that, other kind of things is force rank them. Okay, so how many people have you worked with? 100 people? Would you say this is the absolute best person you've ever worked with? Or would you say he's the top 10, the top 20? You'd be surprised how many times someone is being super cheerful, and then when I ask that question, they say, somewhere in the middle. They're like, oh, okay, all right. And then the other one is, so would you hire this person? And sometimes what you want to hear is like, absolutely, under any circumstances, I'm trying to hire him now for my other company. As opposed to, well, it depends if it's the right position, the right this, the right that. And then you say, what makes it the right position for him, and so on. So, yeah, I can't stress enough how, because getting the right people is the key to most, succeeding in your execution in your startup, and it starts with the selection process. So, yeah.
As an investor, do you do the same due diligence for entrepreneur? How much do you go into their background? How much do you ask about them?
It varies. It varies on the situation. But yeah, I mean, I do try to spend time with them. Back to what I would do with them or with a candidate is same kind of thing. It's like not just ask them for specific situations and what did it do and what were the details and why was it good or why was it bad. So I would try to do that. I would try to do references. What I have to balance with my situation is a little bit different, although I guess for companies, I try to always, I don't want to, if an entrepreneur is talking with a bunch of investors, I want to be very sensitive to their time, to their resources. So for example, one thing I often try to do that works really well for me is, let's say I have an initial meeting, I really like them, and I want to spend more time with them, and I said, let's have a working meeting. I do this all the time. Sounds like you have to figure out your pricing. Are you going to have a meeting about pricing in the next couple of weeks? Yeah. Can I join you for that meeting? Can I go there and try to be helpful? So I go there and I can see them working, but in a context that is not just, their due diligence, what a pain. I'll talk with other people that are potentially thinking about investing. If they already have investors, previous investors. For me, I will say, if I invest in somebody, and I end up, the risk if things don't go well is much lower in the following sense, and this happens to me. So like I was on the board a few years ago, and after a few months, I realized they were not listening to me. I was like, we would meet, I would give them a lot of advice. I say, yeah. And then next time we meet, I'm like, what happened? Oh, well, no, we changed our mind. And after a few months of that, I'm like, I'm wasting my time. I quit from the board. I said, guys, best of luck. Call me if you need any help. Because I'm an independent, I don't have a fund, I'm not overseeing money. The same thing happens. If I make investment, I'm trying to be helpful. If I find, oops, I made a mistake, this person is not somebody I'm enjoying working with, I can back out. And the correlation between that and them being financially successful, those are different things, right? They might still do pretty well, and vice versa. I might spend a lot of time with someone who ends up just not doing well. But yeah, I probably don't do as much as I should, to be candid with you. But yeah. How am I doing time-wise? I'm not sure what.
Another 10 minutes.
Oh, okay, good. This one is one from my first company. So my first company, granted, it was 1994, and I'm saying, people are going to use the web for marketing. I'm going to help those future marketeers understand the demographics of their customers. So I go out in late 94, 95 to the guys that are starting to use the web for marketing and pitch this, and they're saying, what are you talking about? We don't even know how many hits we're getting to our pages. Why don't you start by analyzing our logs and telling us how many hits we're getting? So, okay, let's go after the market. They're telling me that. I go do that. And then I do that, and the companies that I started doing that for were the ad-supported guys, Yahoo, ESPN, CNN. So then they said, our advertisers want a third party to give them the reports. They don't want the way we're doing it now, where it was actually a software as a service. So can you become more of an auditor? So it's like, okay, good. They want me to be an auditor. I'll just follow your customer. So we became an auditor. We partnered with Nielsen Media. And to cut to the chase, we ended up in a business of being like an auditor for ad-supported businesses, media sites. That was actually not as interesting as good as being in the demographic analytic marketing. It was a much bigger, richer space. And eventually the outcome, or the company did okay, but it was really, I think had I go back and do it again, I would have been more patient, and I would have said, you only want to follow your customers if what you're going to do remains strategic to what you want to build as a company. Because otherwise you might be shortchanging yourself, doing something that actually you don't want to be doing. Not everything that customers want is a good business to provide. So you have to balance those things. I think I might have, I have one more slide, and then I want to kind of like open it to make sure we have a little bit of time for just questions. I have found that in Silicon Valley, investors and people in general seem to be so willing to help. I love our community, and I would say I spend about half my time, give or take, just trying to be helpful to people I don't have any formal relationship with. But what I have found is that people who need help, they don't always know how to go about it. So an example would be, somebody from Stanford who's graduating and reaches out to me and says, "Oh, I'm trying to get or for a summer job." I say, "Hey, Ariel, can you help me get a summer job?" I say, "Yeah, sure. What do you want?" I say, "Anything. I'm flexible." Okay, well, that's a tough one. Because then I have to do where do I start? I have to go and ask, well, tell me about your background, what's going to be. Or not, instead, if somebody says, look, I'm really into photography, and I see that such and such photography company has internship opportunities, and that you are connected with such and such from that company, and here's an email, can you please forward that to him? And it takes me 10 seconds, and it's done, and it's valuable. Same thing goes with entrepreneurs who want my help fundraising. I had this conversation 2 days ago. I met with some entrepreneurs, and they're from out of town, process of moving the company here. I said, hey, it wasn't a fit for me. I can't remember what excuse I gave him, but no, I think I was candid. But I said, no, but it's a good project. There's some good entrepreneurs, so maybe there's some other investors that this might be a better fit for. They're like, yes, suggest some. I'm like, no, hold on a second. You do your homework, you find out who are likely good ones because they blog about it, tweet about it, have other made investments, and then you tell me who they are, and then either if I know them, I'll do the intro. If I don't know them, maybe I know somebody, but sort of like help me help you. But it's amazing how I would say it's a minority of the people who go about it that way. Often when I have that response, the majority of people say, yeah, and then that's the end of the conversation, which is mind-boggling, but that's the way it is. So I think that's what I have in terms of prepare remarks, but I can cover anything else that anybody, yeah.
Any advice for managing advisors, keeping them, without sort of hurting cats? So as an entrepreneur, you over time may accrue advisors to help you in key areas.
Mm-hmm.
But they're not employees. Often.
Yeah.
It sounds like you're an advisor yourself. Manage you.
Yeah, well, no, and I've had very valuable advisors in the companies that I've run myself. I'm going to simplify and divide advisors into two buckets. One is the bucket where the advisor it's most likely to help you on a one-on-one basis. So you have to recognize, and that's usually the majority of them. So then what you want to do is make sure you ask for advice on a one-on-one basis. You don't send an email to all of your advisors, hey, everybody, we're looking for blah. And then nobody feels like they're on the hook. Nobody feels like you're talking to them. But if this particular advisor comes from the marketing world and you're looking for a marketing person, then maybe you ask them. The other thing I would say is do small asks that are hard to refuse. If I get a long list of here are 10 things we're looking for, I might just move on. If you say, hey, Ariel, do you have one potential customer you can introduce me to? That's a tough one. I'm going to do it. It's just as So small asks, specifics, targeted to their needs. Don't ask for something that is not aligned. Keep them in the loop. I sometimes get somebody who, not as an advisor, but more as an investor, some of the entrepreneurs might go silent. They don't do a good job at staying in touch. And then out of nowhere, they come up with an ask. And I don't even know what's going on. So yeah, if you want to build a relationship so that when you have a need. The other bucket would be what I would call boards. And this could be either a board of advisors or a board of directors, which can be super helpful. And for those are the ones that you want to have like scheduled, periodic. We're meeting every other month or we're meeting every quarter. There's an agenda. You set expectations of behavior, of attendance, and so on. And that should also help with that. So I don't know.
Thanks.
Yeah.
My question is about angel investment performance. As my knowledge for past 15 years, since 2000 until right now, there are about 250,000 active angel investors in the United States. They invest between 50,000 to 100,000 in a company a year. For past 15 years, it should be 1 million. But only one merger acquisition per 200 angel investment. One IPO per 2,000 angel investment. If we look back 15 years, we just got a few social network companies like Facebook. Where the technology company, product company, large company can, I believe that angel investment level is too low. If there's a good project, good person, they need more money, eliminate it.
So what's your question?
The entry level. The entry. My suggestion is
Okay.
should angel not just care about the money, just a certain amount of money. Should care about the project. Do not go every company, everybody from angel, first round, second round, everything. So this we cannot get a good company. That's have improved this situation. We have to.
Mm-hmm. Yeah. No.
For past 1 million angel investment, good nothing. No good.
Okay. All right. Thank you.
What's your opinion? Based on your opinion, what we should do?
I mean, I think. I started angel investing without any money, if that makes any sense, just by giving my time and helping. So I think people who have time and can help interesting startups should do that. And that, if a lot of people do that, and then maybe when they have money, they put a little bit, that would go on. The macro level, I'm pretty ignorant about, so I can't comment on. Are we out of time?
Yes, you are.
Okay. Thank you all for being here. And